welcome to Aldrich Wealth's first quarter investor update and market outlook. I'm Nicole Rice, partner at Aldrich Wealth, and I'm joined by Darren Richards, a fellow partner and our chief investment officer. Darren, let's talk about stocks. In the fourth quarter of 2018, we saw stocks actually return nearly their worst performance in a decade. Then, fast forward to first quarter of 2019, they returned their best performance since 2009. Can you talk about what contributed to that exceptional performance in the first quarter?
Yeah, and I think before we do that, let's just talk about the downtrend and the uptrend. So worst quarter in a decade, best quarter in a decade. Just keep in mind that that is not that uncommon, because investors, when the sentiment goes negative, they tend to exit the market, usually at the wrong times. And sentiment improves, the market rallies. It's not uncommon to have the best period right on the heels of the worst period. And we really saw that fourth quarter to first quarter. So fourth quarter, as a reminder, in October, interest rates were rising. The 10-year was approaching 3.25. Investors were nervous that if interest rates moved much higher than that, it was really going to slow down the economy. So we saw stocks sell off. November, they stabilized a little bit after the Fed said maybe they were going to be a little bit more on hold. And then in December, stocks returned to the negative territory again, primarily because economic data had worsened. So the economy was starting to slow down a little bit on a global basis. And investors became nervous when the government shutdown took place. So its sentiment again soured. So fourth quarter was awful. And then as January rolled around, the negative sentiment had already kind of been priced into the market. So expectations had been reduced. And the economic data wasn't great, but it was better than expected. And the market loves better than expected. That really helps. So we saw a rally in stocks. And at the end of January, the Fed said, we were kidding about those 2 rate hikes. It's now 0 rate hikes. And that allowed stocks to continue to rally through the quarter. So we had a very, very negative sentiment at the end of the year, very, very positive sentiment in the first quarter. Worst quarter in a decade, best quarter in a decade, back to back. So patient investors were rewarded. And that's, what we preach is stay invested, don't panic, don't let your emotions get the better of you. And it paid off in the first quarter.
Yeah. Speaking of trends, so we continue to see growth stocks outperform value stocks, and we've seen that for the last number of years. Same with first quarter of 2019. Can you talk about why we saw this underperformance continue with value in the first quarter?
Yeah, so just as a reminder, value stocks generally are slower growing, a little bit more defensive, and they pay higher dividends. And they tend to do better at the end of economic cycles when investors become more defensive, a little bit more nervous. And it looked like we were heading that direction at the end of last year, but growth stocks, which tend to be faster growing, a little more economically sensitive, tend to perform better when the economy is doing well. So what we saw was particularly technology, which is the largest sector in the growth indices, rally strongly, very, very strong returns. Consumer discretionary stocks did well. So a number of the growth stocks performed well, or growth sectors performed well, where financials, when interest rates dropped, financials is the biggest sector in the value indices, we saw interest rates drop, and that really hurt financials. They do better when rates are rising. And then some of the more defensive names, such as consumer staples and healthcare, underperformed because investors went from defensive to aggressive and really didn't have much interest in buying kind of low growth, high dividend stocks. They focused more on faster growing stocks. And a la growth, again, outperformed value. It's been the case for the last 6 years, basically. So having a growth bias has certainly paid off recently.
Yeah, thank you. Shifting over to international stocks, speaking of trends that we continue to see. So international stocks actually did well in the first quarter of 2019, but it continues to underperform domestic stocks. Can you talk a little bit about why we see this trend continue, and what will it take for international stocks to actually outperform domestic stocks?
So we finally got a reprieve in 2017 where international stocks, both developed and emerging markets, outperformed domestic stocks. So there's been a very, very wide valuation gap where U.S. equities have outperformed international equities really since '09, if you will. And we've seen the valuation gap widen to basically the widest it's been in well over decades. So international stocks look attractive, but they keep facing headwinds. So in 2017, we didn't have much issues. International stocks did well. In 2018, the U.S. had the tax cuts. So earnings really jumped back up again for domestic companies. So again, investors favored the growth, and they headed toward U.S. stocks. So far this year, double-digit growth for international stocks, but we still have Brexit. We have the China-U.S. trade issues. We have some political unrest across Europe. Japan is a major trading partner with Asia. They've been struggling a little bit. So some of these issues have kind of held back international equities, but the same things that drove better performance in 2017, lower valuations and lower relative interest rates, are still in place. So if we can get some of these other headwinds out of the way, some of these political issues, particularly the trade war with China, if that were to be resolved relatively quickly, it's going to help the rest of Asia, it's going to help Europe. I think that would really be a catalyst to see international equities outperform like they did in 2017. So They're well positioned to outperform, but we need to get a couple things out of the way. So if that happens, again, I think you would see international equities outperform domestic.
Darren, let's drill down on what you just said for a minute. So we saw Chinese stocks surge actually 17% in the first quarter of 2019, despite the trade dispute that you just mentioned between China and the U.S. Can you talk about why we saw Chinese stocks perform so well?
Mm-hmm. If you watch the media, you'd probably think Chinese stocks were really struggling. And what we actually saw was the trade deficit with the U.S. has actually widened over the last several months. So these tariffs have not necessarily hurt China as badly as maybe initially expected. At the same time, the Chinese government was worried about growth, and they cut corporate taxes. They allowed banks to hold a little bit less cash, and they started some infrastructure projects. So they took their own proactive measures to make sure growth stayed a little bit faster, despite possible negative effects from the tariffs. And what ultimately happened was growth initially was expected to drop maybe down to 6.1% or 6% based on this for 2019. And growth expectations have actually been ratcheted up. So it's looking more like 6.3%. So what was initially thought to be a very devastating impact on Chinese equities actually hasn't had that much of a negative impact. And the government taking these proactive measures have actually spurred growth a little bit faster than expectations. So we saw a pretty nice rally in these stocks because they'd been beaten up before. But they're holding it very, very well. And keep in mind, 6.3% growth when you're talking about 2% growth in the developed markets is still pretty attractive. So I think investors actually like that as well. So Chinese equities, despite what you may hear in the media, held up very, very well in the quarter.
Let's pivot now back to bonds. And we saw in 2018 bonds steadily increase in their rates. And then in 2019, we saw that fall off. Can you talk a little bit about why we're seeing that interest rates dropping, and do we think that trend is going to continue?
Mm-hmm. So as you mentioned, interest rates were rising, and that really was primarily because the Fed had said growth is good, inflation is rising. We need to increase rates to head off inflation, to slow down growth a little bit before things overheat. Well, they reversed course on that. So basically they went from we're going to raise rates at least 2 times in 2019 to we're not going to raise rates at all. And you immediately saw that 50 basis points pulled out of the market. So the 10-year, which was up closer to 3.2, quickly dropped down to closer to 2.5, a pretty dramatic shift. At the same time, the Fed said, and we're not going to shrink our balance sheet like we initially planned. So they hold a lot of middle range treasuries and corporate securities that they were selling into the market. So they basically said, in September, we're done. And what that did is it took some supply off the market. So when you have less supply, prices tend to go up and yields tend to go down. So not only did they say we weren't going to raise rates, they said we're not going to sell securities into the market. So that pushed rates down. And then globally, we saw interest rates fall. So I believe roughly 40% of global bond yields are now in negative territory.
That's interesting.
And that was kind of back years ago when that was more of a relevant number. And it had since come back up to barely any. Now we've kind of gone back down again. So on a relative basis, even though our rates are very, very low, they're still somewhat attractive if you look at it from a global side of things. So several headwinds pushed rates lower, and bonds did quite well in the quarter, but then so did stocks.
Yeah, so interesting. Of all the things that you were just talking about, what we saw as a result is the yield curve invert. And as you know, that means that short-term rates are higher than long-term rates, and sometimes that's a precursor to a recession. So I'd be curious what your thoughts are. Is there a recession that is coming in the near term?
Mm-hmm. You're right. An inverted yield curve where long-term rates are less than short-term rates historically has been a good indicator that a recession is coming. And the reason it's been a good indicator is the market is saying in advance of things happening, the Fed needs to cut rates. So short-term rates are too high. It's only a matter of time before those rates drop, and then the yield curve is upward sloping again. But they've kind of predicted this is going to happen. What we have seen more recently, I don't think is necessarily a prediction the Fed's going to cut rates as much as inflation dropped. The Fed said they weren't going to raise rates, so you had that pulled out of the market, and that brought rates down. But the short end of the curve is really controlled by the Fed. So they've got that kind of locked in at roughly 2.5%, if you will. It's not going to drop much below that, and it really only moves after they raise or cut rates. So that's pretty stable. The rest of the market trades, and it moves up and down on a daily basis. So inflation expectations came down a little bit. Global interest rates came down a little bit. The Fed backed away from their rate hikes, and you really saw that part of the curve drop back down to what the market thinks is more realistic rates. So when I look at the flat to inverted yield curve, I'm not as nervous as I would traditionally be because I don't think the Fed has any rate cuts coming in the near future, nor do I see any negative growth. I don't see the recession looming primarily because we're expecting 2% GDP growth. Things are starting to pick back up a little bit on a global basis. If some of these trade issues get resolved, I think you'd see global trade pick back up again. So we're certainly it's a warning signal, but it's not flashing enough to make me nervous. And even when the curve inverts, it's anywhere from a year to 2 years generally before you see a recession. So it does a good job of predicting it, but it does a good job of doing it quite a bit out in the future. So you don't necessarily want to become defensive at this point anyway. The market tends to move higher all the way up almost to the recession. So not nervous, but certainly something that's in the media to be talked about. But I think the cause of it is not that the Fed's going to cut rates. There's other things that are driving the midterm rates lower.
That's perfect. And I'm sure a little bit, hopefully, a relief for some of our clients listening to that. So thank you for that. And thank you for joining us for Aldrich Wealth's first quarter investor update and market outlook.